The stock market looks calm, almost too calm. At the time this video was made, the VEX, the market's fear gauge, sits near 14.56, one of its quietest readings of the year. But underneath that calm, something unusual is happening. Strategists are starting to talk about something almost nobody expected this summer: the possibility of a rate hike in September. Here is the signal. At the time this video was made, the 10-year Treasury yield sits at 4.63%, up 8 basis points in just 1 month. Yields do not climb like that when traders expect easier money. The bond market is quietly repricing the odds that the Federal Reserve tightens again. A hike, not a cut, that is the conversation now. Look at the board. The Fed's benchmark rate has been parked at 3.5 to 3.75% all summer. Inflation has cooled to 3.5%, but it is still well above target. The 10-year yield, 4.63%. The 30-year mortgage, 6.69%. And the 10 years 52-week high, 4.75%, is within striking distance. Why are hike odds rising at all? 3 forces. First, inflation is stuck above 3%, not below it. Second, recent labor data came in strong, and a hot job market gives the Fed room to tighten. Third, long-term yields are already drifting higher, which means the market is doing some of the Fed's work for it. The bond market is blinking first. A repricing like this does not hit every stock the same way. High-growth names, the ones priced on profits far in the future, are the most sensitive to rising rates. Housing and rate-sensitive sectors feel it next. On the other side, cash finally pays a real yield, and financials tend to hold up better when rates stay high. And here is what makes this setup fragile. Volatility is cheap. With the VEX near 14.56, protection is historically inexpensive, and positioning looks complacent. If traders have to reprice a hike quickly, the adjustment could be sharp, precisely because so few are positioned for it. This is not a fringe view anymore. A growing number of Wall Street strategists now say the odds of a September hike may keep rising, and they warn that this alone could inject fresh volatility into markets. Remember, it was only last month that the 10-year touched 4.75%, its highest level in a year. So what if September's not the pause everyone expects? Here is the confirmation board. Yields, the 10-year at 4.63%, climbing. Fear, the VIX at 14.56, asleep. Inflation, 3.5%, stuck. 2 of those 3 say the risk is underpriced. So here is what to watch. First, the September Fed decision itself, and every speech between now and then. Second, the next inflation report, because one hot print could change the odds fast. Third, the 10-year yield against its 52-week high at 4.75. And fourth, the VIX, because cheap protection rarely stays cheap. 4.75% is the line. If the 10-year breaks it, the hike conversation gets very real. And if you want to trade moves like this with a real plan, click the link in the description, scan the QR code on your screen, or go to startwithtA.com to learn more. That is startwithtA.com from the Traders Agency team. That's the briefing from the Traders Agency team. Subscribe for daily market analysis. This is education, not financial advice. Trade smart.